I want you to close your eyes for a second. Seriously, just picture this. Imagine a high-speed train. It's gleaming, chrome-plated, aerodynamic, and for what, the last 15 years it was absolutely tearing down the track. To anyone standing on the platform, this thing looked, well, unstoppable. It was fueled by cheap debt, massive population growth, and, a cultural obsession with ownership that bordered on mania. Passengers, homeowners, investors, developers, they were all clinking champagne glasses in the dining car, watching their net worth tick up with every single mile marker. But now, okay, open your eyes. That train is screeching to a metal-on-metal halt. The steam is venting, the wheels are locking up, and the passengers are all pressed against the glass, looking out at this dense fog, asking the conductor a single terrified question. Are we just stopping, or are we about to roll backward off a cliff?
That is a visceral image. And honestly, it might not be dramatic enough for what the data is actually showing us right now. If you look at the Canadian housing market, specifically, the engine room of the Greater Toronto area, we aren't just seeing a slowdown. We are witnessing a historic recalibration. The momentum hasn't just faded. The very physics of the market have fundamentally changed.
The numbers really are staggering when you sit with them. I mean, we have just closed the books on the slowest year for Canadian housing sales since 2010. And if you zoom in on Toronto, the center of the universe for Canadian real estate, you have to go back a quarter century to the year 2000 to find sales volume this low.
Think about that context for a minute. The year 2000, we were worried about Y2K bugs and dial-up internet. The population of the GTA has grown by millions of people since then. Millions! Yet the raw number of people actually trading keys, buying and selling homes, is the same as it was back then. That disconnect, it implies that the market mechanisms, the gears that make housing move, are fundamentally jammed.
That is exactly what we are unpacking today. We aren't just going to list price drops or interest rates because that's, well, it's boring, and you can get that anywhere. We are telling the story of a psychological shift. We are moving from the frantic seller's paradise, remember those days, 20 offers on a bungalow in a single night, to a complex, tense, and incredibly psychological buyer's standoff.
It is a game of chicken, frankly, and right now, nobody knows who is going to blink first.
Before we try to get this train moving again or figure out where it's headed, I do want to mention that this deep dive narrative is presented by Manoj Atri, Realtor with Remax Hallmark Realty Ltd. He's the one helping us navigate these tracks today by providing the source material for this whole discussion.
So what is the roadmap? Because there are a lot of conflicting signals out there. You have headlines screaming crash and then others screaming recovery. It's confusing.
We have a heavy stack of research to get through. First, we're going to look at the illusion of prices. Why one major bank analysis says we are actually back in 2017 values, despite what the price tag says. We're going to unpack a bizarre flip in the rental market, where the expensive cities are suddenly going on sale, while the cheap cities are getting pricey. Then, we'll look at the hitting tax that's strangling new supply. And finally, the big one, the heavyweight forecasting battle for the next year. The spring thaw versus the renewal wall.
That renewal wall, that's the scary part. It's the math that keeps economists up at night.
It is. So let's get into it. This is the great deceleration.
Okay, let's start with that volume drop we mentioned in the intro. In the GTA, sales plummeted over 11% year over year. Nationally, it's a similar story of decline. When I see volume drop that hard, my first instinct, and I think the instinct of many listeners, is that people just stopped wanting houses. Is that what happened? Did the Canadian dream die last year?
It feels like it should have, right? But no, not even close. If anything, the desire to own is higher than ever because people are watching rents climb in secondary markets and feeling, insecure. The problem wasn't a lack of desire. It was what I call an affordability standoff. You have to understand the psychology of the seller right now. Most sellers are looking at comparable sales from early 2022, the absolute peak of the market.
Right, the Dave down the street syndrome. Dave sold his place for $1.5 million 2 years ago, so my place must be worth $1.5 million today. Even if the roof leaks and the kitchen is from 1980.
Precisely. It's what behavioral economists call anchoring. Sellers are anchored to that 2022 price. They feel that if they accept less, they are losing money, even if they bought the house 20 years ago for $300,000 and are still making a massive profit. But on the other side of the table, you have buyers who are walking into a bank and being offered mortgage rates that are triple what they were in 2021.
So the buyer physically cannot qualify for the price the seller thinks they deserve. It's impossible.
It's just simple math. The purchasing power of the average Canadian household has been slashed by interest rates. So you have sellers refusing to lower expectations and buyers physically unable or, frankly, unwilling to meet them. The result isn't a crash, it's silence. Nothing happens, no transaction, just a stare down across the kitchen table.
Usually, though, when sales dry up, inventory dries up too because sellers they pull their listings and decide to wait. But the data for this quarter is showing something different, isn't it?
That's the warning light on the dashboard. New listings in the GTA were actually up roughly 10%. So sellers are still coming to market. They need to sell or they want to sell. But because the buyers aren't biting, that inventory is just piling up. It's accumulating like snow in a blizzard that won't stop.
And Economics 101 says if supply goes up and demand goes down, price must fall.
Eventually. But housing is sticky. It takes a long time for sellers to accept reality. We are seeing a slow leak rather than a burst pipe. Prices are drifting down, but not crashing in nominal terms. And that brings us to a concept that is absolutely critical to understand if you want to know what your house is really worth.
You use that word nominal. This is a distinction that BMO Capital Markets highlighted in the recent analysis, and it's brilliant. I think a lot of people get confused here. If I look at the headlines, the average selling price in the GTA dropped about 4.7% to just over $1 million. That's a dip, sure.
Yeah.
It's the price of a mid-range sedan. It doesn't feel like a catastrophe.
That is the nominal price, the sticker price, the number written on the check. But nominal prices are an illusion because money itself changes value. We've lived through a period of very high inflation. The cost of bread, gas, cars, insurance, services, all of it has gone up significantly. Our money is worth less than it was 3 years ago.
So if my house price stays flat at $1 million for 3 years, but inflation is running at 5% a year, I've actually lost value.
Exactly. You've lost purchasing power. And when BMO adjusted the Canadian housing data for inflation, when they looked at real prices, the result was shocking. In terms of what a house is actually worth relative to other goods in the economy, we aren't in 2024 or 2025 values. We are effectively back in 2017.
2017. That's nearly a decade of gains wiped out in real terms.
Yes. They call it the silent correction. It's silent because you don't see it on your bank statement. If you bought in 2020, on paper you might be break even. You think, phew, I didn't lose money.
Yeah.
But if you sold that house today and tried to buy the same basket of goods you could have bought in 2020 with that money, you'd find you are significantly poorer. The asset has depreciated against the currency.
That explains the mood out there. It feels heavy. It feels like everyone is holding a bag that is slowly getting lighter, but they're afraid to look inside. And this heaviness is really showing up in the bidding process too, or I guess the lack thereof.
The era of the bidding war, that adrenaline-fueled frenzy where you had 15 minutes to decide on the biggest purchase of your life, is effectively dead. We have some fascinating data from Wahi, the digital real estate platform. They track bid versus ask data across the GTA. Right now, 98% of neighborhoods are in underbidding territory.
98%. That's basically the entire map. It's a complete inversion.
It is. And remember, for nearly a decade, the strategy in Toronto was list low, sell high. You list a house for $799, but you actually want $950. It was a staged auction. Now, the strategy is list at what you hope to get and pray someone offers 95% of it. The psychology is flipped from FOMO, fear of missing out, to a new acronym I like, FOP.
FOP.
Fear of overpaying. Buyers are terrified of being the idiot who bought at the top. They are scrutinizing comparable sales with a microscope. They are putting in lowball offers. And what's really interesting is where the deepest underbidding is happening. You'd assume the luxury market is insulated, right? Rich people usually weather these storms better.
Counterintuitively, it's the opposite. The wealthiest neighborhoods, Forest Hill, the Annex, York Mills, are seeing the deepest discounts relative to listing price. We're talking about properties listing for $3 million and selling for $2.6 or $2.7 million.
Why is the top end so soft?
Liquidity. The pool of buyers who can afford a $3 million home at 5% interest is tiny. And rich buyers are savvy. They don't buy falling assets. They have other places to put their money, stocks, bonds, treasuries that are yielding 4 or 5% risk-free. They aren't desperate for shelter. They're looking for value. If the value isn't there, they just walk.
But there are exceptions. The data showed a couple of neighborhoods still seeing overbidding, specifically Bridlewood and Wexford in Scarborough.
The exceptions prove the rule. Those are historically the most affordable pockets of the city. We saw modest overbidding there, $15,000 or $20,000 over ask. This tells us that the demand hasn't evaporated, it has just been compressed downwards. People who wanted to buy in Leaside are now looking in Scarborough. People who wanted Scarborough are now moving to Hamilton. Everyone is sliding down the ladder to find a rung they can afford.
Which is a perfect segue to the rental market. Because if you slide far enough down the property ladder, you eventually fall off and become a renter. And for years, the narrative there was boringly consistent. Rents go up. If you don't buy now, you'll be priced out of rentals too.
The narrative has shattered. We are seeing a phenomenon I call the Great Rental Convergence.
Break that down. Convergence implies things are meeting in the middle.
Exactly. Historically, Canada had a massive spread. You paid a huge premium to live in Toronto or Vancouver, those superstar cities,
Yeah.
and you got a massive discount to live in Edmonton, Saskatoon, or Halifax. That gap is closing from both ends simultaneously.
Okay, let's start with the big cities. Rents are actually dropping in Toronto.
Significantly, we've seen the sharpest declines in 4 years, down 5 to 8% in Toronto, Vancouver, and Calgary. If you are a tenant looking for a condo downtown, you have more choice and better prices than you've had since the pandemic lockdowns.
What is driving that? Is it just that nobody can afford the rent, so landlords have to cut prices?
It's a classic supply and demand pincer movement. Think back to 2020 and 2021. Interest rates were zero. Developers launched a record number of condo projects. Those massive towers take 3 to 4 years to build. Well, guess what? They are all finishing right now. We have a tsunami of new condo completions hitting the market, and most of those units are owned by investors who need to rent them out immediately.
So supply is just flooding in? What about demand?
Demand has been legislated down. The federal government, reacting to the housing crisis and infrastructure strain, put a hard cap on temporary residents and international students. That removed tens of thousands of renters from the university towns and the downtown cores. More keys, fewer tenants, prices drop. It's basic economics finally working.
Okay, so that explains Toronto. But you said the gap is closing from both ends. What's happening in the so-called affordable cities?
The opposite. While Toronto cools, Edmonton is on fire. Rents in Edmonton grew by over 17% recently. Montreal and Saskatoon are surging too.
17% rent growth is astronomical. Yeah. That's a crisis level for a local family who hasn't seen their wages go up 17%.
It is, and it's driven by internal migration. We spent 2 years telling Canadians, drive until you qualify. Well, they drove. They drove to Alberta and Nova Scotia. They brought their Toronto salaries or their Toronto home equity cash, and they bid up the local rental markets.
It's almost like we exported our affordability crisis from Toronto to the rest of the country.
That is exactly what happened. The arbitrage is gone. You can no longer move to a secondary city and expect 1990s prices. The discount has been eaten by the crowd.
There's another layer to this rental story that I found fascinating and, honestly, a bit worrying for the stability of the market. It connects back to those condo towers you mentioned. We have to talk about the investor's dilemma, because a lot of those units hitting the market aren't owned by big corporations. They're owned by mom-and-pop investors.
This is the pre-construction trap. Imagine you are a regular person, a dentist, a teacher, a small business owner. In 2021, you signed a contract to buy a pre-construction condo for $700,000. You put down a deposit. You assumed that by the time it was built, the unit would be worth $900,000 and you could rent it out to cover the mortgage.
A pretty safe bet for the last 15 years. You couldn't lose.
Until now. Now the building is done, you have to close. But the bank appraises the unit at $650,000. You are immediately underwater. You have to come up with extra cash just to get the mortgage. And because rates are 5%, your monthly payment is $4,000. But because rents are dropping, as we just discussed, you can only get $2,400 in rent.
You are bleeding $1,600 a month in negative cash flow on an asset that is worth less than you paid for it.
Exactly. And that bleeding is unsustainable. This is why we are seeing so many assignment salespeople trying to sell the contract before the building even closes, often at a loss. But there's a deeper structural issue emerging. Developers are panicking because they can't sell the units. So some are trying to pivot entire buildings from condo, sell individual units to purpose-built rental, keep the building and rent it out.
That sounds like a smart pivot. If you can't sell, rent. We need rentals anyway.
It sounds smart until you talk to an insurance underwriter. I was reading a fascinating report from Canadian Underwriter that highlighted a major snag here. The risk profile of a condo building is totally different from a rental building.
How so? I mean, concrete is concrete. The building doesn't change just because the person inside rents instead of owns?
Not to an actuary. In a condo, every owner has a vested interest in the property. They usually carry their own content insurance. If they fled their unit, their insurance deals with it. In a rental building, tenants are transient. They often don't have insurance. If a tenant starts a kitchen fire or overflows a bathtub, the liability falls on the building owner.
And things like amenities, pools, gyms, playgrounds, they become huge liability magnets in a rental context.
Exactly. A playground in a condo is an amenity for owners. A playground in a rental complex is a lawsuit waiting to happen if a kid falls. So insurers are looking at these converted condo projects and saying, we didn't sign up for this risk. They are hiking premiums or refusing coverage. It's a hidden friction point that is making it even harder to bring supply to market right when we need it most.
Which brings us perfectly to the next big topic, the supply paradox. If you listen to any politician from any party, the slogan is build, build, build. We have a shortage. We need millions of homes. Yet the data shows housing starts are struggling to gain traction. Why aren't we building?
It is the ultimate frustration. We have the land. We generally have the labor. But we have a hidden stack of costs that makes building financially impossible. And the biggest villain in the story isn't the price of lumber or the greedy developer. It's the government itself.
We're talking about development charges or DCs?
Yes. For the listener who doesn't know, a development charge is a fee. A municipality charges a developer for the right to build a home. In theory, it pays for the new sewers, roads, and libraries the new residents will need. Growth pays for growth, right?
Sounds fair. Why should existing taxpayers subsidize the new guys?
In theory, it's fair. In practice, it has become an addiction for municipalities who refuse to raise property taxes on existing homeowners. In Toronto, DCs on single detached homes have risen nearly 600% since 2011.
600%. Inflation over that period was maybe, what, 40 or 50%. So this is exponentially higher.
It is a massive disproportionate tax. When you buy a new home in the GTA, there is roughly $100,000 to $150,000 of pure government fees baked into the price. The developer doesn't pay that, the buyer pays that. It is a hitting mortgage. You are taking out a loan to pay a tax to the city.
So the city says we want affordable housing, but then they slap a $150,000 entry fee on the front door.
Exactly. And this creates a vicious cycle. The fees are so high that developers can't make the numbers work, so they cancel the project. If the project is canceled, the housing doesn't get built. If the housing isn't built, the city doesn't collect the fee. Nobody wins. It's a lose-lose equilibrium.
And this financial gridlock is turning into political warfare? We saw that flare up recently with the federal government and the city of Toronto.
The Sixplex saga. This was fascinating theater. The federal government has a housing accelerator fund. They basically said to cities, if you want this money, you have to allow density. You have to allow fourplexes or sixplexes on any residential lot as of right.
As of right, meaning I don't need to go beg the city council for a zoning variance. I can just build it.
Correct. The feds withheld about $10 million in funding from Toronto because the city council balked at the sixplex idea. The city wants to protect neighborhood character and, frankly, their existing voter base who hates density. The feds want to unlock supply at any cost.
So you have the feds pulling the gas pedal, the city slamming the brakes, and the developers and buyers are just passengers getting whiplash.
That is the state of supply in Canada. Paralysis. And until we fix the tax structure of development, until we stop treating new housing as a cash cow for city budgets, we are structurally underbuilding.
Okay, let's pivot back to the people. We've established the market is slow, prices are down in real terms, and supply is stuck. But someone is buying houses. Who is actually active in this mess?
This was the biggest surprise in the data for me. You would assume, given the affordability crisis, that the youngest generations would be completely washed out. But according to survey data from WAHI, it is the millennials who are keeping the market on life support.
The millennials. The generation we spent 10 years calling the locked-out generation.
The very same. The data shows that 25% of millennials plan to buy a home in the coming year. That is significantly higher than Gen Z or Gen X.
Why are they so resilient? Is it just desperation?
It's demographics and acceptance. Millennials are now in their 30s and early 40s. These are the peak years for family formation. You get married, you have a kid, you get a dog, you need space. You can only live in a 600-square-foot condo for so long with a toddler. So the biological imperative is pushing them.
They can't wait for the perfect market anymore. Life is happening now.
Exactly. And they have also reached a stage of acceptance. They have realized that 1.5% interest rates were a historical anomaly. They aren't coming back. So they've made peace with 4.5% or 5% rates. They are budgeting for it. They are cutting back elsewhere.
Contrast that with Gen Z, the 20-somethings.
Gen Z is discouraged. Their intent to buy has dropped. They look at the math, they look at their entry-level salaries, and they say, no way. They are checking out of the housing game before they even start. And the boomers, They are staying put. They have paid off houses. They are aging in place. They aren't downsizing as fast as we thought they would because where would they go? Rents are high and condos are expensive. So the millennials are the only engine running.
But there is another group we need to talk about, the wait-and-see crowd. This isn't a demographic, it's a mindset.
This is the pent-up demand theory. We know there is a massive amount of capital sitting on the sidelines, people who have the down payment, who have the income, but who are terrified of catching a falling knife.
They don't want to buy today if the house is going to be $50,000 cheaper tomorrow.
Right. They are waiting for a signal. They are waiting for the Bank of Canada to cut rates further, or they're waiting for headlines to say prices have bottomed. This creates a coiled spring. The market looks dead, but the tension is building. If sentiment shifts, if we get 2 or 3 months of price stability, all that demand could rush back in at once.
Which leads us to the billion-dollar question. What happens next? We're looking at forecasts for the next year. And it seems like the experts are split into two very different camps.
It's a tug of war between the optimists and the realists.
Let's hear the optimist case first. This is largely coming from the real estate boards, groups like CREA and REMAX.
Their narrative is the spring thaw. They argue that interest rates are trending down, we've seen cuts, we expect more. Cheaper money improves purchasing power. Eventually, that millennial demand will snap, buyers will flood back in, sales volume will normalize, and prices will stabilize or even tick up. They view the current market as balanced, a healthy pause before the next growth cycle.
It sounds plausible. Rates go down, prices go up. That's the historical correlation. But the economists, the banks, the analysts, they have a darker view. They are talking about a second leg of correction.
Their fear is grounded in something called the renewal wall. And this is where the math gets ugly.
The renewal wall. It sounds like a Game of Thrones obstacle.
It's scarier because it's real. In Canada, most mortgages renew every 5 years. If you bought a home in 2020 or 2021, you locked in incredibly low rates, maybe 1.6 or 1.8%. Those mortgages are all coming up for renewal in 2025 and 2026.
And they are not renewing at 1.8%.
No. Even with recent cuts, they are renewing at 4.5 or 5%. Even if rates drop a bit more, the spread is massive. We are talking about monthly payments increasing by 30%, 40%, sometimes 50%. For a typical Toronto mortgage, that could be an extra $1,200 or $1,500 per month leaving the household budget.
That is a massive shock. That's the money for the car lease, the vacations, the restaurant meals.
Exactly. It's a consumption shock. Even if people don't default on their mortgage, they will stop spending on everything else to pay the bank. That slows down the entire economy. And for the most vulnerable homeowners, investors with negative cash flow, or families who stretch too thin, they won't be able to pay.
So that leads to distressed sales.
Forced selling. And forced selling drives prices down. If you have to sell in 30 days, you take the low offer. That sets a new, lower benchmark for the neighborhood. That is the second leg down that the realists are worried about.
And it's not just the mortgages. The broader economic picture is getting a bit cloudy too, isn't it? We've seen unemployment creeping up.
It's around 6.8% nationally. That's not a recessionary disaster yet, but it's not the tight labor market of 2022. Job security is wobbling. And then you have the geopolitical wildcards. We've seen the headlines about President Trump's tariff threats. If the U.S. starts a trade war, Canada gets hit hard.
And if you are worried about your job at a manufacturing plant in Oshawa because of tariffs, you're certainly not going to take on $1 million mortgage.
Exactly. Uncertainty is the enemy of big-ticket purchases. If you think you might get laid off, you renew your lease. You don't buy a house.
So putting it all together, the rates, the renewal wall, the economy, what shape does this recovery take?
It is almost certainly not a V shape. We aren't going to bounce back to peak highs overnight. It looks more like a U shape, or maybe even an L shape.
A long, flat grind.
Yes, a period of stagnation. Prices might drift lower or stay flat for a while. Affordability will improve slowly, not because prices crash 50%, but because wages slowly catch up and rates slowly drift down. It's going to be boring. And honestly, boring is what we need.
A boring housing market.
Yeah.
I think a lot of Canadians would sign up for that after the roller coaster of the last 5 years.
It's a healthy grind. The market was overheating. It was running on fumes and speculation. Now it's sobering up. It's like the hangover after a really wild party. It hurts, but you need to go through it to get back to normal.
So let's wrap this up. We've covered a ton of ground. The train has stopped. The fog is thick. What are the big takeaways for our listener?
First, context is everything. We are in a historic cooling period. Real values, inflation-adjusted values, have reset to 2017 levels. That is a massive opportunity if you are a buyer with cash and a long-term horizon. You are buying a decade of growth at a discount.
But it's a sobering reality if you are a seller or a recent buyer. You aren't as rich as you thought you were 2 years ago. The paper wealth has evaporated.
Second, the rental flip. The old rules are dead. Big cities are offering better deals for tenants due to oversupply. Small cities are becoming affordability traps due to migration. If you are a renter, check the big city listings again. You might be surprised.
Third, the supply nightmare. Until we fix development charges and the political paralysis around zoning, we are structurally underbuilding. That puts a hard floor on how much prices can fall in the long run. Scarcity is real, and it will eventually drive prices back up when demand returns.
And finally, the outlook. It's a race. A race between the Bank of Canada cutting interest rates and the renewal wall crushing household budgets. That is the storyline to watch for the rest of this year and into the next.
So practical advice, if you're a buyer listening to this,
You have leverage. Use it. The data says 98% of places are selling under ask. Don't be afraid to negotiate aggressively. Don't be afraid to put in a stink bid. Time's on your side. You are the pretty girl at the dance now. The sellers are waiting for you.
and for sellers.
Radical acceptance. The days of putting a sign on the lawn and booking a flight to Hawaii are gone. You need to price competitively below the last sale, not above it, or you will sit on the market for months. If you don't have to sell, maybe don't. If you do, price for speed.
And for everyone else.
Watch inventory. That is your signal. If inventory spikes this spring because of distressed sellers, prices will drop further. If inventory stays absorbed, we might see stabilization. Inventory tells the truth.
It's a complex market, probably the most difficult one to navigate in a generation. It requires more than just reading headlines. It requires professional guidance.
Absolutely. You need someone who understands the nuance of your specific neighborhood, because the difference between Forest Hill and Scarborough right now is night and day.
That brings us to the end of this deep dive. We hope you feel a little more oriented in this strange new landscape.
It's going to be a fascinating year. Keep your eyes on the data.
Indeed. This deep dive narrative was presented by Manoj Atri, Realtor with RE/MAX Hallmark Realty Ltd. Thanks for listening and keep watching the tracks.